Hello everyone and welcome to another accounting video. Today we're going to be going over a really big issue in accounting, inventory cost systems. So to give a sort of introduction to this, I'm going to repeat sort of what we've done in the past, which has been whenever we buy inventory, we record it at cost, which we'll still do, and then when we sell it, cost of goods sold is what we bought the inventory for. So if you say buy two items at $5 each, be minus 10 in cash, and then inventory would go up. And then if you were to sell item, say both items for $8 each, here I'll put in, sell for $8 each, you'd get, and say you receive cash, you'd get $16 in cash and $16 in revenue, and of course you sold that inventory. So $10 of inventory you sold, so negative 10 and negative 10 cost of goods sold. And if you're not used to this, I'm just going to use COGS always as cost of goods sold. But we run into a problem. And the problem is, what if we buy inventory at different amounts? So say we sold one item, bought one item of inventory at $5, and then later we bought another item of inventory at $6. Same inventory, just the price went up. But we only sold one. So what is our cost of goods sold? Is it $5? Is it $6? Some other method? That is what inventory issues in accounting, what we try to get at. So to answer that question, you actually have some options. And here are the four main options right here. First is specific identification. Couldn't be easier. It's just you actually physically keep track of what inventory is which when you sold it. So you would actually keep the two items, the $5 and $6 ones, separate, keep track of them, and then when you sold one, you knew exactly which one you sold. That is not common. That is really useful when you have very big items. Let's say you're Boeing and you make airplanes. You probably only make so many airplanes a year, so it's very easy to see, okay, this inventory of airplane will very specifically identify this. But again, it's not common because most of the time you have lots of inventory at lots of different prices, and keeping track specifically of all those would be very unrealistic. So, to combat that, we also have these methods right here. First, last in, first out. Sorry, I shouldn't have said first there. But the first one I'm going to talk about is last in, first out. And this is chronologically by time. You keep track of when you bought what orders at what price. So here, let's say that this is listed chronologically. At some date, we bought the $5 item, and then later, at a later date, we bought the $6 item. Last in, first out means whatever is the last one we bought, that's what cost of goods sold is. So in this instance, if we were to do last in, first out for selling one item, it will be the later in time, the $6 one. Now the other one, first in, first out, FIFO, that's just the opposite. So it's the earliest that you bought it for, so it would be the $5 one. And the sort of in-between, I guess you could say, well, not really, it's just a different method, weighted average, which is just using math. So the general formula is each parentheses is a different time that you buy, at a cost at a certain price point. So at some point in time, you bought so many units at a cost per unit times cost per unit plus, and then in parentheses, the different number of units at their different cost per unit, and then you divide by total number of units. And so if you were to do that, right here, so you can see $5 plus $6, the 5 and the 6. I didn't take the time to multiply by 1, but you still get the idea. And then divide by the total number of units too. So your cost would actually be $5.50. And on top of that, sorry to make it a little bit even more complicated, there are two, I guess you could say, or there's another thing to think about, which is, are you going to use perpetual or periodic? Now, what does that mean? That means just when you do these calculations, you can either do them perpetually, which is every time you make a sale, you do the calculations with the available information you have. So if I was doing it perpetually, you see I have my timeline right here in order, earliest to latest. January 1st I bought, January 2nd I bought, January 3rd I sold. So this is when I do my calculation for what cost of goods sold is. However, you also can do it periodically, which means at the end of the period. So let's say for whatever reason, I chose to break things off into 8 days or something like that. I mean, honestly, normally the accountant chooses a month, a quarter, or an annual period, but let's just, for sake of example, say this is my entire period. This right here, periodic, you would actually wait till the very end, January 8th, and that's when you would do the math with choosing one of the specific identification, last in, first out, or weighted average. So as you can see, those numbers are going to be different for the most part depending on what you sold. The only difference is perpetual and periodic weighted average are going to be the same. Why? Well, they're going to be the same because first in, first out, you're always choosing the earliest one. Oop. So that won't really matter if you choose periodic or perpetual, but everything else, weighted average, LIFO, specific identification, that matters on the time period that you choose. So let's make an example just to go over something. So first, we always want to make a timeline. So I'll just stick with just these first couple days of January. So whenever you have a problem like this, or you're doing just accounting in general, always keep track of time, and especially with inventory costing, making a timeline is the best. So we'll say we bought 15 units of inventory at $5 each. And then we bought 10 units at $20 each. Then we sold, let's say, 12 units. And then we bought, another 10 units, let's say $18 each. And then we bought 12 units, $22 each. So this is just our timeline. Let's not make it too complicated. So first, let's say we wanted to do, we'll do perpetual. Now perpetual specific, I'm going to cut out the specific identification because, again, that's the easiest one. You're normally not asked a question when it comes to specific identification, and it's extremely rare. So I'm just going to go over the other three, the weighted average, the LIFO, and FIFO. So, anyway, so let's do perpetual FIFO. Okay, so perpetual means you're always going through and doing calculations. So perpetual FIFO means as soon as we make the sale, we're going to go, okay, what's our cost of goods sold? So perpetual FIFO, first in, first out. Well, we go to the earliest, which is in this case January 1st. Bought 15 units at $5 each. Okay, so we're going to use this line to figure out our cost of goods sold. So our cost of goods sold is just going to equal the 12 units we sold times they were $5. Now, last in, first out is going to be, again, this is perpetual. So imagine, with perpetual, even if you have all this information right now, perpetual, it's as if we only have this information because we're doing the calculation as soon as a sale is made. So we do the calculation on January 3rd, which means our last in is this January 2nd right here. So $20 each except, as you can see here, we sold 12 and we only have 10 of these units. So what do we do in this situation? You do the best you can. So first we're going to use all 10 units of the $20 each, but we sold 12, so those other 10 units will have to come from this line right here. You know, they call them layers, you know, LIFO layers. So the cost of goods sold is going to equal 10 times 20 plus 2 times 15. Exactly. So 5 and 20. So good, good, good. Now, and then weighted average. First we find the weighted average, which is going to be, 15 times 5 plus 10 times 20. And then that means together we have 25 bought 15 and then bought 10. So $11 is the weighted average. We sold 12, so 12 times 11, 132. So again, this is just figuring out the total cost, total number of units, dividing them. This is the weighted average. Anyway, so then what we have is periodic. Now, again, as I said earlier, periodic and perpetual, first in, first out, are always the same. Because even if we wait till this point in time, which is what perpetual is, periodic is, waiting till the end of the period, the first is still this top line. So periodic and perpetual, first in, first out, won't be different. Now, however, the others will. So last in, first out, well, this is chronologically. We're waiting till this, the very end of the period to do our calculations. The last in, first out is now the January 5th purchase, the last one. The chronologically last one is this one right now, January 5th. Bought 12 units and $22 each. So now we're using 22 times 12, 264, compared to here, 230. And then weighted average means that we have to do this for everything. So 15 times 5 plus 10 times 20 plus 10 times 18 plus 12 times 22, and then 15 plus 10 plus 10 plus 12, number of units. Get that jumble of a mess. And then we sold 12. So 12 times this number. This is our cost of goods sold. So that's the main difference. And perpetual versus periodic, you're still looking at the four, specific identification, first in, first out, last in, first out, or weighted average. It's just when you do the calculation. So that's all you really need to worry about for that. Now this can get more complicated when you have multiple cells throughout a timeline. Okay? So what that's going to happen is, let's say right down here, we had sold 12 units again. We're still going to figure things out earliest to latest with last in. So first we figure out the January 3rd, then we figure out this. It's just that you have to be very careful when you're doing something like weighted average, perpetual, because every time we sold units, like weighted average perpetual right here, it was $11, but then we bought more, so then we'd have to adjust our math. But be careful, because we don't have as many of these previous units because we sold them. So it's just with weighted average perpetual and with multiple sellings in a period, you just have to be careful because you always need to keep track of your math, how much you have, how much you sold, and always readjust that number. So that's all it is. Now, anyway, so that's the main idea of these inventory systems. And here you have, I guess you could, every once in a while we throw in ratios. Gross profit ratio is net sales minus cost of goods sold divided by net sales. Net sales is just your sales minus your allowance. Now, what is the allowance? Allowance for doubtful accounts. That's something we're going to get into really soon right down here. But so just hold off on that for now. And then inventory turnover is cost of goods sold divided by average inventory. And as you can see here, I made a little note. The beginning of one period is, the end of one period is the next period's beginning. So let's say you're given, December 31st, 2011 is the same thing as the beginning inventory of year 2012. So, and then of course average just means taking the beginning inventory plus the ending inventory and dividing by 2. That's all it is. And what inventory is getting at here is just whenever you see the word turnover, that means how quickly we're getting it through our operating cycle. So efficiency is what we're talking about. And then, profit, we're just obviously talking about profitability. How much, what percentage of our sales do we get in gross profit? Which changes industry from industry. And those, in this point in the time, you won't really be expected to probably understand in depth why these ratios are thought about. That's more of a finance issue, but just know that inventory turnover, we're looking at how quickly we can go through inventory, and then gross profit ratio, just looking at profitability on the gross profit, which is big, because cost of goods sold, you can only really control that by getting deals from your suppliers. A lot of the other things in your company, you can control costs a lot better. You could try and, if your wage expense is really high, you could try and train employees to be more efficient. If you have, really, say, for example, a really high, I'm trying to think of some accounts we've gone over yet. Or let's say your operating expense, like your electric bill is really high. Maybe you could try and be more energy efficient and everything like that. But gross profit, that's one of the things you can really only decrease that. Ideally, really only decrease that by increase your gross profit by decreasing your cost of goods sold, and you could only decrease your cost of goods sold by without doing funky accounting, like saying, we're going to change from one costing method to the next just because we have less expense, which is not what you're supposed to do. You can really only do that by getting better deals from your sellers. But that brings up a good point. Let me get into that really quickly. As you can see here in our example, generally speaking, over time, the cost of things go up. So, normally it wouldn't be like this jump, $5 to $20 most of the time. And then, of course, you can see it went down a little bit right here. But generally, over time, what happens is costs of goods, your inventory increase. So LIFO is normally much more expensive, is a much higher expense than using FIFO. Now, why would you do that? Here's the deal. If you have higher expenses, then that means you also have lower net income, which sounds bad, but when you think about it, lower net income means you pay lower taxes. Now this, I want to make a very serious attempt here. This is what you need to understand. What we're going over right here is financial accounting. All right? And tax accounting, although it's very similar, you use a lot of similar ideas. You have a whole different set of rules for cost accounting. For financial accounting than you do tax accounting, and you don't have to use the same systems. All right. So the deal is for most 99.9% of the time, what you do for financial accounting, you're allowed to do different for tax purposes, and also for tax purposes, tax law has a lot of its own rules and regulations. Again, very similar to financial accounting, but not the same. That being said, that other 0.11% of the time, you have something called the LIFO conformity rule, which is saying for this one time, financial accounting needs to equal tax accounting. So if you use, last in, first out for tax accounting, you have to use it for financial accounting. That's all it is. It's the one little rule, doesn't make really much sense, but that's what the regulators came up with because they thought for whatever reason it was unfair to be able to switch, and when you're allowed to do it in literally every other aspect of accounting. So for this one time, they made a rule that what you do for financial accounting has to equal tax accounting, just in the area if you choose last in, first out. You're still allowed to do everything else differently. It's just if you choose last in, first out for your tax accounting, has to be the same for financial accounting. So, over here when I said cost of goods sold, it can be messed with if you choose a different inventory system or mess with bad debts expense to a certain degree. But let's not, again, I'll get into that later. But for the most part, what you need to understand is that gross profit can be changed with cost of goods sold, and that's one of the few things that you have not as much control over in a company. You sell your inventory, what you bought it for, and that's really your relationship between you and your suppliers. And again, inventory turnover, just how quickly you're selling your inventory. Efficiency. So anyway, I think I'm going to stop there for today. It's a lot to get thrown at you. What I really recommend is going online and looking at, say, example problems and trying to do them on your own. The math is actually really simple for a lot of these when you really think about it. There's only 4 things, and you can either do them perpetually or periodic. Those are your only options. It's just when you have a whole timeline of buying and selling things, you just need to be very careful that you're keeping track of what you bought and what you sold and when, and how much you have left over. So I'm going to end it there. Again, I recommend looking at practice problems, and I'll see you next time. Thank you.